Today we are going to talk about the exchange traded product. In our content, we're going to cover about who are we as the issuers of the largest product in the continent. We'll talk about the new generation for investing, which is basically the exchange traded product. We'll talk about the global trends. We're also going to cover the structures of the ETF. We're also going to touch base on how ETF has actually evolved and what are the expected drivers that drive the ETF globally. And we're also going to talk about how can the ETF help a market to develop. And I think key to this presentation is to talk about why do we actually even have to invest in ETF in particular as a pension fund. We're also going to talk about the uses of the ETF and how to use them in portfolio strategies. Who are we? We are the largest issuers of ETF in South Africa, as well as across the continent. We've got about 21 different exchange-traded products listed with the JSE as a primary listing, and then some of them are secondary listed in various parts of the continent. In terms of the market pie, we basically own about more than 44% of the market pie in terms of all the issuers of the ETF, in particular JSE. We actually have some of our flagship products that have actually done very well across the globe. One of them is a New Blood, which was listed in 2013. It actually became the world's largest platinum ETF, and even today. Another product that we pride ourselves with is actually New Gold, which is basically the largest ETF in the continent and is the largest gold product in South Africa as well. In terms of asset class, I mean, we obviously recognized the need of the pension fund that as part of their mandate, they need to diversify their investment risk. So we are the issuer that actually offers your widest asset class. We actually have ETF that covers different asset class. We cover precious metal, we cover equity, we cover money markets, we also cover balance funds, as well as different kind of products. We also involve in ETNs, which actually covers your currency, covers some of the precious metals. So we are basically not only the largest issuers of the ETF in the market, but we also actually cover different class compared to all our peers in the market. So basically, ETF are exchange-traded products that are listed on an exchange, and they actually trade like a share. Maybe to put it more simple, I'm sure most of you actually understand the unit trust. Most unit trust has been around for quite some time. So ETFs and unit trust are not very different. They actually belong to the same family called mutual funds. So the main difference between the ETF and unit trust is that the ETFs are listed on the exchange and there's more transparency about it. Whereas the unit trusts are actually issued by the management, and as an investor you can only buy through a management. The ETF you can buy via the stockbrokers, investment plan, and so on. So it's exactly the same as unit trust in terms of how it operates, in terms of how it's structured, but just that actually it's listed on the exchange and is actually highly regulated by both the exchange and your capital market authorities, which is an added benefit for investors who want to get comfort. Now, how do those actually products actually differs, or how they actually give investors the benefit? So they're basically structured in such a way that if I'm an investor who actually don't have time to study the market and understand which companies are doing well, I can actually buy an ETF which is designed, say for instance, designed at the back of an index that actually captures all the stocks in the market. In other words, by buying an ETF linked to a particular index, therefore I'm able to actually, by buying one security, I'm able to buy all the shares making up the index. In other words, one security is able to give me an exposure into the entire market. Say, for instance, I'm an investor. I want to invest in a particular sector. Say maybe I actually like the financial services sector. I want to buy insurance companies as well as the banks. So one way of doing it is to actually go and instruct my broker to buy individual shares making up that portfolio. But with ETF, it's actually easy. An ETF can be created at an index which is designed to focus only on that particular sector. And then at the back of that, as an investor, I can just be able to go and buy one security, which is an ETF, which then gives me the exposure into the best performing companies in that particular sector. Say I'm an investor, I also want to get an exposure into alternative asset class like commodities, like gold or diamond or say platinum. So one way of getting an exposure into gold is to actually go and buy physical gold into the mining company, which is actually not easy. And the challenge is that, I mean, if you buy gold there, if people know that you actually own gold, they can actually come to your house and try to steal it. So you're exposing yourself into a risk. So The other way to get an exposure into gold is to actually buy shares in the mining company that actually mines gold. Now, the challenge with that is that sometimes you find that there's management risk, or say, for instance, there's a strike. You find that the price of the underlying commodities will tend to increase because the demand is there, but the supply is not there. But what will happen then to the share price of that company? You find that the share price of that company which mines gold actually will go down because of the strike. So as an investor, you're not directly getting an exposure into the spot performance price of the commodities. So the most efficient and the cost-effective vehicle to give you an exposure into a commodity is actually gold. So that is basically how ETFs can actually help you to get an exposure into asset class that would have been difficult to get an exposure into had they not been created. The most important thing for the ETF in particular for the pension fund is that they are liquid. I mean, pension funds want to buy into securities that they are able to hold, and if they feel that they don't like it, they can be able to sell it. So ETFs are very liquid, and why they are liquid is because there is a requirement from the exchange that for ETF to be launched, it must have a market maker. Now, a market maker is someone whose main role is to provide liquidity. Say, for instance, there is the demand outstrip the supply. People want to buy more ETF. The market maker's role is to make sure that he or she is the seller of the last resort. He must always make the ETF available. So you don't run into a situation whereby you've got a very good company and people want to buy and the shares are not available because maybe the big buyers like pension fund have bought it. So ETF is open-ended. You can buy as many as possible. So that is why they are used by various exchanges to deepen the market. Say, for instance, now I'm a pension fund, I've bought all the gold ETF, and all of a sudden something happens in the market, the global economy is improving, and I want to get rid of my gold. It's actually difficult if I were to hold physical gold. I would need to find a buyer, and where do I start? But with an ETF, the market maker is forced to buy gold ETF from you. So that is actually good in the sense that if you want to manage a very liquid portfolio, ETF is the best way to go. But what is also key about ETF is that not only that they've got all those kind of benefits, they are also cost effective. They are low cost. And the reason why they are low cost is because, they are passive in nature, meaning that you don't have someone sitting in the office trying to analyze the market for you. So they are based on a predefined, well-researched strategies or based on commodities. And over and above that is one of the very few instruments that is actually give you a benefit of protection because it's not only regulated by one regulator, but by various regulators. So that is actually a good product for pension funds to look into and to consider. So on a high level, you find that an index has been created based on a research, based on a study to say, had this index has been around for quite some time, this is how your fund would have performed had you invested according to the index. So once that index is actually created and identified, then the issuers of ETF, which is basically what Barclays does, will then create an ETF which is designed to mimic that index. So at the back of that ETF, then securities will be issued, then that will be held by investors like pension funds. But what is important is that, you find that most of the ETFs are issued by investment banks or they're issued by asset managers. And you find that maybe investors will be concerned to say, what happens if this bank actually collapses? Or what happens if this asset manager actually collapses? Will I lose my money? The answer is no. So the ETFs are actually ring-fenced. In other words, if Barclays issues ETF and Barclays collapse, the investors of the ETF are not affected by the Barclays activities because the ETF is a separate entity issued out of a ring-fenced vehicle. In other words, there's no issuer risk. So in each and every security that you hold as an investor, it's physically backed. If it's gold, it will be backed by physical gold. If it's platinum, it will be backed by physical platinum. If it's actually the index, an equity links index, then it must be backed by shares of the companies making up the index. America is by far the largest issuers of ETF in the market. It is not because purely they are big in size. Yes, size also to some extent does matter, but I think what is actually driving the success is that, it is one of the very few markets in the world whereby actually the investment is embraced by both institutional investors as well as the retail. So in other words, there's a balanced mix in terms of investors. Whereas if you go to Europe and in Africa, you find that the biggest investors of ETF are your pension fund, your asset managers, and so on. You find that the retails don't actually invest because they're not quite familiar with what the exchanges actually offers, because the ETFs, as I said, they are listed on the exchange. So therefore, in order for you to understand the ETF, you need to actually understand where to find them, which is basically the exchange. So America has done very, very well in making sure that the retail investors understand its products and they embrace them, which is why then they are doing very, very well. If you actually further scrutinize in terms of the asset allocation just within the ETF, you will note that the biggest ETFs are designed to create, to track equities. As you can see, equities is basically 3.5 trillion in total across all the regions, and then followed by the fixed income. And then thirdly is actually commodities. That is actually an interesting story, because if you come to Africa, which is basically where we're from, you find that the opposite is true. In fact, when it comes to Africa, commodities ETF are by far normally the largest ETFs in a particular African country. I'll use Botswana as an example. I think here we've got about 4 ETFs. 2 of them are actually commodities. And if you look in terms of trading activities, you find that platinum and gold ETF are the one that actually trades more than other ETF. This is the same situation in South Africa as well. I mean, we've got probably about 48 ETFs, but if you look at the contribution of the AUM, the majority of the money goes into commodities, because we are African, we understand our resources very well. Now, what is actually driving such a huge growth in ETF? There's basically an investment theme that says there's a shift to passive. Meaning that all these years, most investors have been privy or have been exposed to the active strategies, whereby you get a fund manager to pick stock for you to give you alpha. So now there's been a move whereby it's becoming now globally accepted that there are other strategies that can also help you to grow your investment, which is basically passive. Passive is basically index-based kind of investing, whereby you actually try to own the market, whereby you're saying, instead of me trying to identify companies doing very well in the market, I can actually just own the market, because maybe it's not always easy for anyone to continuously beat the market. So there's then a move towards passive, and one of the key selling points for passive is that it gives you diversification, and 2, that it's a low cost. So that shift is the one that actually drives the biggest growth from your traditional kind of investing to the passive. So that is actually driven largely by the US. US has been involved in that kind of a shift for the past 10 years. Ernst & Young has gone further and said, you know what, it's not only about we see ETF growing, but in fact, in 2017, so I see it's in 2027, their prediction is that the passives, the assets under management from passive would have actually exceeded the assets under management from active. And they're saying that the reason for their prediction is based on the fact that, unlike before, where there was a huge debate between the active guys versus passive guys to say active strategy is the best or passive is the best, now it came to a point whereby there's a growing acceptance to say, apparently, you can actually use both strategies to give your investor a good value. In other words, if I'm a pension fund, I should be able to actually have my portfolio, some of it invested in active and some of it invested in passive, or maybe a mixture of the two. And therefore, in terms of their analysis, that have been such a combination give you a greater value and a greater exposure. So in other words, now we begin to see more embracement of investing in passive. That is one of the drivers that's going to actually assist the passive to outstrip the AUM of the active in future. But over and above that, the issue of a shift to passive on its own is also going to be the biggest driver of that. As we see, in fact, if you look at the AUM that actually goes into different type of investment, you find that passive is already receiving a lion's share in terms of receiving more assets as part of investment compared to passive, so compared to active, and that will actually result in the passive actually really actually taking over from the active. We have seen Sanlam also buying Cetrix. Cetrix is one of the issuers of ETF. And most recently, we've seen another asset management firm actually bought Deutsche. Deutsche also issuing ETF. So in other words, we actually see asset managers beginning to embrace the passive strategy by actually offering passive products into their clients. So as a result of that, this is where then there's a belief that passive will in future actually outstrip the active products. Now, passive, when you talk about passive, you're not only talking about ETF, you're talking about unit trust, you're talking about ETF, but the biggest benefactor of this passive move is actually the ETF. And why is ETF? Because it's very simple. Because the ETF, they are low cost compared to other products within the passive space. And 2, they benefited more from market volatility. And thirdly, because of the intraday activities, because ETF you can be able to buy anytime during the course of the day, whereas if you buy unit trust, you have to wait sometimes to understand where the unit trust price is sitting, you need to wait for the closing price and so on. So ETFs are operating more exactly like a share, so you're able to, at a given point in time, to see what's the value of your ETF, and therefore that is actually a good benefit for them. And this is why most of the money when it comes to passive is actually going to go to ETF. As trustees, it's important to understand these products because they're going to affect you. In fact, I can tell you some of the products that are here in the exchange that I just talked about, they're already, your asset managers actually buy them for you, so they're already part of your portfolio, but it's important that you understand what products are they buying and why they're buying them. So it's important to empower you with that kind of knowledge to be able to make a good investment decisions. The research has found that the biggest buyers of ETF are pension funds, as insurance companies, and some investment funds. And the reason why they are doing this is because they want to manage the liquidity for their funds, and also they want to get an access into other alternative asset classes that they would have never been able to do it had they invested direct, i.e. gold. And another biggest buyer who's going to drive the growth of ETF is actually the private banks, and they want to use ETFs to select some exposure, to get an exposure into international market, because it's easy to do it with ETFs. You can have an ETF designed to track, say, maybe the S&P 500, for instance, and by buying that product, you're able to tap into the foreign market. So the private banks are using that for that kind of exposure. The wealth managers for high net worth individuals, they're also actually getting more involved into the ETF, and they want to drive the ETF growth, and they're going to be using the ETF as a core exposure for their client. Interesting enough is that even some hedge funds as well, they're going to be using ETF going forward. In fact, currently they're already using the ETF, but I think the rate at which they're going to use them is going to be even much more compared to what we've seen in the past. And around 2015, it was for the first time that ETF actually outstripped the AUM of the hedge funds globally. Remember, hedge funds have been around for so many years. ETF are just new. Maybe they're around about less than 30 years old, and already they actually overtaken the hedge fund, which has been around. So the next step is other asset class as well. So these are basically the drivers of the growth in ETF, and in particular to note, pension funds are the biggest drivers of that, because they recognize that with ETFs, you can be able to get more diversification, you're able to manage your risk, and so on. Now, what is actually interesting in terms of the analysis that, South Africa, yes, were the first country to come up with ETFs in the continent, then followed by Botswana. But it did not take that much for the Botswana people to understand ETF compared to South Africa. And in fact, it was only a year that ETF were listed, which was basically new gold ETF in 2010. Within a short space of time, Botswana were able to embrace the ETF and be able to invest in ETFs. In other words, you guys are much more ahead of us in terms of understanding this kind of complex products. Now, one will ask, but Michael, these ETFs, yes, we understand they are used for pension fund, they are used for men on the street, they are used for, but how do they actually, benefit some of the African market? What we have found is that most of the African exchanges, they actually struggle in terms of having sufficient products to supply or to feed into the local investors. For instance, you find that pension fund will want to diversify their risk, and then the stock market may be so small that, pension fund can be able to absorb the stock market within a short space of time. And therefore, because of that, there's no stocks available, then we find that there's a problem of now having more demand, but there's no supply. And they also want to diversify their risk by investing in different asset classes. So the ETF has been used by various exchanges in the continent to deal with the issues of illiquidity, to deepen their market. So by bringing an ETF is not only actually talk about giving investors an opportunity to invest in different products, but also it actually plays a role in actually developing your capital market, because they're open-ended, and it gives investors also, people are getting much more comfortable by investing in products as well as investing in the stock exchange. And as and when that happens, the market starts to grow, people begin to embrace in investing and becoming comfortable with investing in general, and therefore your market grows.